Hello and welcome to a CMS Forex Daily Market Recap. I'm your fundamental market analyst, Nick Nassad. Today is Friday, May 14, 2010. Let's start today with a look at the euro-dollar pair, where the euro dropped under the 1.24 level to its lowest level since October 2008, extending its losses from earlier in the week and helping to boost the dollar and yen. We had renewed fears of fallout from the Eurozone debt crisis as well as general risk aversion as equity markets fell. While there weren't any fresh developments that spurred the euro's latest slide, it was simply an extension of earlier losses this week as markets are doubtful of a plan to get out of its sovereign debt crisis by in essence issuing more debt and loans. Criticism is also widening about the ECB's decision to start buying sovereign debt in an effort to boost market liquidity and limit contagion from Greece's debt crisis. Fear is also growing that austerity measures to reduce budget deficits may stir further civil unrest in those countries. Finally, investors were also spooked overnight by a Spanish report that French President Sarkozy threatened to pull France from the Eurozone when demanding that other countries in the Eurozone help Greece. Overnight, we moved below a very key level, which was the 125 area, and then retested it as resistance in overnight trade. This low was our low from last Thursday, when we had the very sharp drops in equities around the world and a freeze up in credit markets as a result of the Greece crisis. While the slide was a little bit more controlled in this week, especially in our three sessions in the middle of the week, we still wind up lower than where we were in last week's low. Zooming out to a weekly chart, here's our 1.25 level, and we could see that that was the level that we had been near in March of 2009, and today's low actually goes back to our lows in October and November of 2008. That was the bottom for the euro-dollar pair following the financial crisis that had started with the Lehman Brothers collapse, or well, not started, but it was the most aggressive part of that unwinding in financial assets. So if we take a look at that low as our reference point and we see that we're testing it, if we zoom this pair out further, we see that there isn't much support after that level until we reach perhaps the 1.16 level here, which is our lows from December of 2005. So if we continue to slide in this pair, I know it's a little hard to see with the chart. Let me remove the high-low zones, but as you can see, below this 125 level, our next real support comes around 1.16. Now we'll see what developments come out of this weekend, if there are any new measures introduced by the European Union, Eurozone, and the ECB, or the Fed or the IMF or any other big institution in order to try and quell the unease in financial markets right now. Otherwise, we're just going to see a continued devaluation of the euro in investors' eyes. Jumping back to an hourly chart, here we're looking at the dollar-yen pair, and we had been consolidating for most of this session after our sharp volatility in last Thursday's session. But today we did move lower in favor of the yen, as it is a safe haven during times of heavy risk aversion. We broke this short-term upward sloping trend line and then retested it as resistance, and then we finally did find some support at a low for the week at the 91.80 level. Stocks in Europe were off more than 3%, with the main index in Paris down 4.6%. Equities in the US were also off more than 2% prior to the close for the week, while oil was down 4% by late New York trading, and there was a general exit of investors from higher risk assets and into safe havens like the dollar and yen. We did see a little bit of a bounce back in this pair in the final hours of New York trading. If we take a look at the euro-yen, however, we see that we had a much more clear down move in today's trading until we found support at 1113.50, which extended the decline in the pair throughout the week, though we didn't hit, unlike in the euro-dollar pair, we didn't hit the lows that we had seen on last week Thursday's session. But with the environment the way it is, we should continue to see the euro-yen decline as any carry trade positions continue to be unwound in the pair. Switching to the pound-dollar pair, the UK is being hurt by similar fears of debt to GDP ratio as well as large budget deficits, despite the talk from the incoming government that is their main priority. We saw the pound slide in Thursday's trading rather sharply, breaking below our low for the week and creating a double top pattern in the pair, while today we moved lower to the 1.45 area where we found support and we wound up consolidating in New York trading. Here we come close to testing our lows from Thursday, so that last Thursday, so that would be our overall support coming back from the weekend. And a quick look at the euro-pound pair. Unlike in yesterday's trading where the pound was more pressured than the euro, here we have the roles reversed with the pound gaining on the euro, as it was the euro that suffered the most in the last trading session of this week. Moving over to one of our commodity currency pairs, the US dollar Canadian dollar. Here we see a move in favor of the greenback, though we did top off around the 1.0350 area in New York trading. Here the sharp slide in oil and deterioration in investor sentiment contributed to this quote-unquote risk-off trade. In today's session on the hourly chart, well, it started in yesterday's session. We moved above our short-term moving average, and then as we moved into the Asian trading, we moved above our medium-term moving average, and in New York trading, we moved above our 200-period longer-term moving average. Today's high was also about a 38.2% retracement of our recent downswing from our high around 1.0750 to our low of 1.01. I had mentioned how oil had been pressured today, and we settled at a 3-month low below $71.50 a barrel. Now we should take note that we were near $85 a barrel just 2 weeks ago. So that pressure on one of Canada's main exports has been pressuring the Canadian dollar, at least to end this week and to end last week. The Australian US dollar pair also moved in favor of the greenback as we moved below this upward sloping support trend line. We had sort of seen this triangle shaping up in yesterday's broadcast, and we had moved below all of our moving averages overnight, and we used them as resistance and then fell to a new low for the week around 0.8850. So we could see the overall theme of traders and investors shunning riskier, higher yielding assets for the safety of the greenback. Surprisingly, even gold, which had been a very strong performer, fell in today's trading, though it did test a new all-time high just below the 1,250 level. We had reached that and then fell down to 1,217, though rebounding in the New York session. So still we're up for the week. We came in around 1,205, and we will be ending higher. And during this environment where sovereign debt risk and strain in the overall global financial system is apparent, traders and investors will look for gold as a tangible asset and could start to act as pretty much its own currency. So with all that being said, we did also have some fundamental data from the US, though it did not affect the currency markets all that much. We had US retail sales for the month of April rise 0.4%, which was a slightly better than increase, and it was also the 7th straight rise in a row. We also had March's rather sharp rise to an even better than originally reported 2.1%. Today's report, while not increasing at the same pace as the previous month, was still a good sign that consumers continued to spend during the recovery. Industrial production for the month of April rose 0.8%, slightly higher than forecast and better than the 0.2% move we saw in March. It might be hard to make out, but a lot of the rise was due to manufacturing, which for a second straight month rose 1%. Finally, we saw the the preliminary version of the UMich consumer sentiment for the month of May, and it increased to 73.3 from April's 72.2. While current conditions remained just about where they were in April, future expectations increased slightly. As you can see from the charts to the right, after rallying during most of 2009, consumer sentiment, we have plateaued, and the last 6 months or so, we've been stuck in this range in the low 70s. That will do it for our coverage of the Forex market for this week. For more news, videos, and analysis, please visit our site. I want to thank you for watching and wish you a great weekend.